Silver didn't top. It got hit. Hard. In a matter of days, it ripped into the low 80s, flirted with the mid 80s, and then the floor vanished, and price got slammed back into the low 70s, as if someone pulled a lever. Most people saw the red candles and called it a collapse. But that reaction misses the only detail that matters. After all that violence, silver is still holding above 70. That is not a comforting detail. It is a diagnostic one. When an asset can absorb a sharp down day, survive a forced drop, and still refuse to surrender the level that used to be unreachable, you are not watching a market cool off. You are watching a market get tested. And the test is aimed at you, specifically at your time horizon, your patience, and your exposure. This isn't coincidence. Because markets do not produce that kind of whiplash without a reason. The timing is too clean. The hit is too targeted. The result is too specific. If this move were simply a change of heart, price would not be hovering above a zone that used to reject every rally. It would be living back under it, trapping everyone who bought the breakout and humiliating the narrative in public. That did not happen. Instead, we got something more revealing. A rally that sprinted, followed by a reversal that looked mechanical, followed by a market that refused to give back the entire breakout. That combination tells you the battle is no longer about whether silver can break old ceilings. The battle is about whether it can be forced back under them. This pattern has appeared before, where the most important signal is not the spike up and not even the hit down, but what remains afterward. Once this stage begins, the crowd usually focuses on the headline move and ignores the structural message. The message here is simple silver just demonstrated it cannot be kept under the old framework the way it could for decades, and that changes what risk actually means from this point forward. What most people did next was predictable. They saw the speed of the drop and assumed the conclusion had already been written. Sharp decline means the top is in. Volatility means exhaustion. Pain means the move failed. That logic feels intuitive, but it is backwards, and markets punish intuition when it replaces structure. Real market tops do not arrive in environments like this. They arrive when doubt has been extinguished. They arrive when participation is broad, confidence is high, and the dominant emotion is certainty rather than anxiety. At true endings, price does not need to be slammed down. It rolls over gently because everyone is already leaning the same way. Nobody is being forced out. Nobody is panicking. They're comfortable. That comfort is the signal. Look at what just happened in silver and compare it to that profile. The room is not comfortable. It is divided. Comment sections are arguing. Holders are questioning themselves. Late buyers feel punished. Early participants are uneasy rather than euphoric. That is not what distribution looks like. That is what unresolved pressure looks like. This isn't coincidence, because markets have a long memory of how endings behave. When something is truly over, it does not require violence to convince participants. It simply stops rewarding them. The recent move did the opposite. It punished leverage, not conviction. It attacked positioning, not belief. That distinction matters because one is emotional and the other is mechanical. This pattern has appeared before, where a sharp move down is misread as failure, when in reality it is enforcement. Enforcement of rules, enforcement of capital requirements, enforcement of who is allowed to stay in the trade. When volatility spikes during a breakout phase, it is often because the system is struggling to contain participation, not because interest is disappearing. Once this stage begins, the most dangerous mistake is assuming that discomfort equals wrongness. Discomfort is often engineered precisely because it produces exits. The market does not reward comfort during transitions. It uses stress to thin the field. And when you reframe the recent move through that lens, the narrative shifts. This was not a verdict on silver's potential. It was a stress test on its holders. To understand why this matters, you have to step away from the day-to-day price action and look at how large breakouts actually unfold over time. Not in theory, but in practice. Markets do not move from suppression to resolution in a straight line. They move through stages, and each stage serves a specific function inside the system. This pattern has appeared before, across commodities, currencies, and even equities when a long-standing ceiling finally gives way. The first stage is always prolonged containment. Price spends years, sometimes decades, pressing against a level it cannot clear. Participants internalize that ceiling as permanent. Strategies, risk models, and narratives all form around the assumption that the level will hold. Then comes the second stage, the break itself. Not a slow drift, but a decisive push that forces the market into unfamiliar territory. This is the moment that triggers disbelief. The majority does not trust the move because it contradicts years of experience. Participation increases, but cautiously. That hesitation is critical because it means positioning is still light. The third stage is acceleration. Price moves faster than expected, not because fundamentals suddenly changed overnight, but because the constraint was artificial and its removal creates imbalance. This is where attention rises, headlines appear, and volatility expands. Importantly, this is also where leverage begins to pile in, chasing confirmation rather than cause. What follows is the stage most people misunderstand: the forced reset. This is where the system intervenes, not through opinion, but through mechanics. Volatility spikes margins, tighten liquidity thins, and positions that rely on borrowed stability are flushed out. To the untrained eye, this looks like failure. In reality, it is filtration. The market is separating durable demand from fragile exposure. Once this stage begins, the outcome is no longer about the initial breakout. It is about what survives the reset. If price collapses fully back under the old ceiling and stays there, the breakout is invalidated. The system restores the prior regime. But if price absorbs the shock and remains elevated, something more permanent has occurred. That leads to the final stage, repricing. Not a straight line higher and not immediate resolution, but a shift in baseline. Levels that once acted as ceilings begin behaving like floors. Volatility remains, but it operates within a higher range. Psychology adjusts slowly because it has to unlearn years of conditioning. This isn't coincidence. It is how transitions assert themselves. The recent behavior in silver fits this sequence precisely. A long containment, a decisive break, rapid acceleration, a violent reset, and now a test of whether the new altitude can be maintained. At this point in the cycle, the most important information is not how far price moved, but where it refused to go back to. What drives this stage is not sentiment and it is not narrative. It is plumbing, the internal mechanics of how modern markets are built and enforced. And to understand the recent move, you have to understand how exposure is actually held and how risk is policed when volatility accelerates. Most participants do not buy silver by paying for the full value up front. They rent exposure. Futures contracts allow large positions to be controlled with a relatively small amount of capital posted as margin. Under normal conditions, that system functions quietly in the background. But when price starts moving too fast, the risk to the clearing system changes. The exchange does not care whether traders are right or wrong. It cares whether obligations can be met if the market keeps moving. This isn't coincidence, because when volatility spikes after a breakout, the first response is almost always administrative. Margin requirements are raised. The cost of holding the same position increases overnight. Nothing about the metal changes. Nothing about demand changes. What changes is who can afford to stay. At that moment, a forced decision is introduced. Either additional capital is added immediately, or positions are reduced. For participants using leverage aggressively, there's often no choice. Selling becomes mandatory even if their long-term view remains intact. That selling is not an expression of belief. It is an expression of constraint. This pattern has appeared before, and it always produces the same visual effect. Price falls sharply, liquidity thins, and the move looks emotional from the outside. But internally, it is mechanical. The system is flushing positions that depend on borrowed stability. That is why these drops look like cliffs rather than slopes. They are not negotiated, they are executed. Once the stage begins, the market accomplishes two things at the same time. It reduces systemic risk by shrinking leverage, and it transfers exposure from weak hands to stronger ones. Participants who are not overextended are not forced to act. They can observe, absorb, and wait. That asymmetry is intentional. It is how markets restore balance after a regime change. This is why the recent decline cannot be read as a verdict on silver itself. The move targeted structure, not substance. It punished gamblers, not holders. It relieved pressure in the derivatives layer while leaving the underlying market largely intact. And that distinction matters, because when a breakout survives a forced deleveraging, it signals that demand exists beyond paper positioning. Understanding this mechanism reframes the entire episode. What looked like rejection was enforcement. What felt like failure was filtration. The system tightened the rules, tested participation, and asked a simple question: who is here because of leverage, and who is here because they intend to stay? For decades, there was one number that defined silver's limits more than any other. Not 70, not 80, 50. That level was not just resistance on a chart. It was a psychological boundary built through repeated failure. Every major rally in modern history ran into that zone and lost momentum. Each time the market learned the same lesson, silver could approach it, test it, even flirt with it, but it could not live above it. That conditioning mattered. Traders built strategies around it. Investors anchored expectations to it. Risk models treated it as an outer boundary rather than a threshold. Over time, 50 became less a price and more a rule. And rules like that do not disappear quietly. This pattern has appeared before, where a market spends years reinforcing a ceiling until it feels permanent. When that ceiling finally breaks, the event itself is only half the story. The more important question is what happens afterward. Does price snap back under the level and behave as if nothing changed, or does it struggle fight and remain elevated despite pressure? This time silver did not simply tap 50 and retreat, it blew through it. And more importantly, after the system intervened and volatility surged, it did not collapse back into the old range. That is the tell. A failed breakout does not need to be defended. It fails on its own. Price falls back below the former ceiling and stays there, turning every buyer into trapped supply. That did not happen here. Instead, silver absorbed a violent shakeout and continued to trade in a zone that would have been considered impossible for most of the last generation. That behavior signals something subtle but critical. The market is no longer negotiating whether 50 was valid resistance. That debate is over. The level has been resolved. Once the stage begins, psychology has to adjust even if participants resist it. The reference point shifts. The question stops being whether silver can ever hold above 50 and becomes how the market behaves now that it already has. The transition is uncomfortable precisely because it forces a rewrite of assumptions that were reinforced for years. This isn't coincidence. It is how long-term barriers lose their power. They do not vanish in a clean, celebratory move. They are broken, tested, attacked, and then slowly forgotten as the market operates above them. The recent price action did not disprove the breakout. It validated it by showing that even under stress, the old ceiling no longer functions the way it once did. There's one signal in the current setup that matters more than headlines, more than daily candles, and more than social media sentiment. It is not what silver did. It is what the mining stocks did not do. In the late stages of a true commodity cycle, miners do not lag. They explode. Capital rushes in because the story becomes simple. Higher metal prices translate directly into higher margins. Earnings visibility improves, and leverage to the underlying move becomes obvious even to casual observers. That is when charts turn vertical narratives, become unanimous, and skepticism disappears. That is what an ending looks like. That is not what we are seeing now. Silver surged. Volatility followed. And yet a large portion of the mining sector barely reacted. Some names moved modestly. Many did nothing. That disconnect is not a warning sign of exhaustion. It is a signature of disbelief. This pattern has appeared before, where the underlying asset breaks out, but the equities tied to it remain neglected. Capital has not rotated yet. Analysts are hesitant. Allocators are cautious. The trade still feels uncomfortable to explain in a committee room. And that hesitation matters, because it means the market is not crowded. The easy money has not shown up. The late money has not even decided whether the story is real. This isn't coincidence, because miners are where conviction shows up, last, not first. They require belief not just in price, but in duration. When participants doubt whether elevated prices will persist, they hesitate to reprice businesses whose cash flows depend on that persistence. That hesitation is exactly what you would expect during a transition, not at a peak. Once this stage begins, the asymmetry becomes clear. If silver were truly finished, miners would already be discounting that reality. Earnings expectations would compress. Risk would be priced aggressively. Instead, the sector is largely asleep, as if it is waiting for permission to believe. The waiting is not passive, it is latent energy. When metal prices stay elevated long enough for cash flow to show up on income statements, disbelief becomes expensive. Analysts revise models. Institutions rotate capital. What looked like indifference turns into urgency, and the same stocks that lagged suddenly start behaving like amplifiers. The current divergence tells you something precise about where the market is in the sequence. The metal has moved, the structure has shifted, but the broader capital base has not committed. That is not how cycles end. That is how they prepare for their next phase. What makes this transition more unstable is that silver is not being pulled by a single force. Two pressures are converging at the same time, and each one alone would be enough to strain the system. Together, they remove any expectation of orderly behavior. The first pressure is monetary, and it is often misunderstood. This is not about an overnight collapse of the dollar or a sudden loss of faith that triggers panic. It is about erosion, slow, cumulative, and difficult to reverse. When currencies lose purchasing power gradually, capital does not react with drama. It reallocates quietly. It looks for stores of value that do not depend on promises, balance sheets, or policy credibility. That shift does not announce itself. It shows up as persistent demand that refuses to disappear even when price is attacked. The second pressure is industrial, and it is far less flexible. Silver is not just a financial asset that can be replaced with another line on a spreadsheet. It is a physical input embedded deep inside modern systems. Energy infrastructure, electronics, and advanced manufacturing rely on it in ways that are difficult to substitute without cost or delay. When demand from that side tightens, it does not negotiate with sentiment. It draws metal out of circulation. This pattern has appeared before, where a material straddles both monetary and industrial roles at the same time. In those moments, price behavior changes character. It stops responding politely to technical expectations and starts reacting to stress. Moves become sharper. Pullbacks become more violent. Not because the thesis is failing, but because the system is trying to reconcile two types of demand that operate on very different timelines. This isn't coincidence, because when monetary hedging meets industrial necessity, volatility becomes a feature, not a bug. Futures markets amplify that tension. Paper claims can expand and contract rapidly, but physical availability cannot. When those two layers fall out of sync, the price becomes the battlefield where the imbalance is expressed. Once this stage begins, attempts to suppress price through leverage and positioning grow less effective over time. Each flush clears paper exposure but leaves the underlying demand intact. The result is a market that feels unstable on the surface but increasingly rigid underneath. That rigidity is what matters. It explains why sharp sell-offs fail to restore the old order. It explains why levels that once capped price now struggle to contain it. And it explains why volatility keeps returning rather than resolving. Silver is no longer moving as a single-purpose asset. It is being pulled by forces that do not agree on timing, and that disagreement is exactly what makes the transition visible. At this point, the logic tightens, and the room for alternative explanations narrows. If the recent move were the end of something, the market would have behaved very differently after the shock. A true failure does not linger. It does not hesitate. It does not invite debate. It collapses back into the prior range and stays there long enough to erase doubt. That is not what we are observing. After a violent hit designed to force exits, silver did not surrender the ground it had just taken. It did not retreat into the zone that defined its limits for decades. Instead, it stabilized above it, despite volatility, despite skepticism, and despite repeated attempts to shake confidence. That behavior carries weight because it contradicts the narrative that the move was accidental or speculative. This pattern has appeared before, at moments when a market transitions from one regime to another. In those moments, the most important signal is not strength, but resilience. Strength can be fleeting. Resilience requires structure. It requires real demand underneath the price, not just momentum on top of it. This isn't coincidence, because markets do not repeatedly test a level unless that level matters. The fact that silver is being attacked rather than ignored is itself information. If the breakout were harmless, it would not need to be disciplined. Price would be allowed to drift lower naturally as interest faded. Instead, we are seeing sharp interventions followed by stubborn persistence. That is the signature of a market being challenged, not dismissed. Once this stage begins, the burden of proof shifts. The assumption is no longer that the breakout must fail, but that it must be proven invalid. And invalidation requires more than volatility. It requires sustained acceptance back below the former ceiling. Until that happens, every attempt to force silver back into its old framework only reinforces the same conclusion. The framework itself is no longer holding. This is where inevitability enters the picture, not as a prediction of price targets or timelines, but as a structural reality. A market that survives repeated stress above a historic barrier is not behaving randomly. It is signaling that the rules governing its range have changed. And once those rules change, the path forward is no longer about whether this shift occurred, but about how the system adapts to it. At this stage, the mistake is trying to turn structure into prophecy. The market is not asking for predictions. It is asking for discipline. When transitions are underway, the most damaging behavior is emotional overreaction, either chasing strength or capitulating into weakness. Both assume certainty where none exists. The correct response is procedural. Instead of asking where price will be next month, the more useful question is where failure would have to appear if the thesis were wrong. That shifts focus from hope to evidence. A genuine reversal would require silver to lose the very ground it just fought to establish not temporarily but persistently. Until that happens, volatility alone does not invalidate the structure. This isn't coincidence, because markets reward those who respond to information, not noise. Sharp moves are designed to provoke decisions. Structure is designed to guide them. The task here is not to react to every candle, but to observe whether pullbacks are being absorbed or rejected. When declines are met with demand rather than abandonment, the message is cumulative, even if it arrives unevenly. This pattern has appeared before, where the most profitable positioning was not aggressive timing, but patience aligned with confirmation. Participants who survived transitions did not do so by predicting exact turns. They did so by avoiding forced errors. They kept exposure manageable. They avoided leverage that could be weaponized against them. They allowed the market to do the work of clarification. Once the stage begins, monitoring replaces guessing. Attention shifts to whether buying interest returns at higher levels than before, whether selling pressure diminishes after each shakeout, and to whether related markets begin to respond with a lag rather than a lead. These observations do not demand constant action. They demand consistency. The goal is not comfort. Comfort is rare during regime change. The goal is alignment with structure while preserving flexibility. If the market proves the shift wrong, it will do so clearly, and there will be time to respond. If it continues to defend its new range, patience becomes an advantage rather than a liability. This approach does not promise certainty. It removes unnecessary risk. It acknowledges that transitions are noisy, that signals arrive imperfectly, and that survival through the process is more important than precision within it. What matters now is not treating silver as an isolated story. What you are watching here is a localized expression of a much broader process. Markets rarely reprice a single asset in a vacuum. They move in clusters driven by pressures that sit above any one chart or sector. The behavior you have just seen in silver is a symptom of something larger adjusting beneath the surface. The same forces that produce forced resets, margin stress, and violent tests in one market do not stop there. They propagate. They show up in other metals, in currency relationships and capital allocation decisions that seem unrelated until you step back far enough to see the pattern. This isn't coincidence, because transitions in monetary regimes do not announce themselves with a single event. They reveal themselves through a sequence of stress points. One market moves first, another lags, a third resists, and eventually the connections become impossible to ignore. Silver is rarely the leader in public attention, but it has often been an early signal when the cost of real things begins to change. This pattern has appeared before, where assets tied to physical constraints start behaving differently long before policy or consensus adjusts. At that stage, the most important risk is not volatility. It is misinterpretation. Treating a structural signal as a short-term anomaly leads people to the wrong conclusions at exactly the wrong time. Once this stage begins, the question is no longer confined to whether silver can hold a level. The question expands outward. What happens when multiple hard assets start reflecting the same pressure? What happens when capital begins to distinguish between paper stability and physical reality across markets, not just within one? That is the lens the next discussion will use, not to predict outcomes, but to connect signals. Because silver does not exist alone in this process, and understanding where it sits requires understanding what is shifting around it.